something big is happening behind the curtain of the financial system. Wall Street's private credit machine, a multi-trillion-dollar shadow banking industry, is showing cracks. Institutional money is starting to slip out the back door, while the public is being quietly ushered in through the front. And where do they want to send the risk? Straight into America's retirement system. Your 401k, your IRA, your life savings. At the same time, the financial architecture is being rebuilt around stablecoins, digital payments, and programmable currency systems that could usher in an era of unprecedented financial surveillance and monetary control. This isn't speculation, it's already unfolding. The question is whether Americans recognize the warning signs before the next phase of the digital dollar reset locks into place. For decades, retirement accounts were built around a fairly simple structure. When Americans saved into a 401k or IRA, their money typically flowed into assets like public stocks, bonds, and index funds. Markets that were transparent, liquid, and regulated. You could see the price, you could track performance, and when you needed your money, you could usually get it. But that structure is beginning to change. Policy discussions in Washington and financial lobbying on Wall Street are pushing regulators to open the door for retirement accounts, to invest in private equity and private credit markets, the least transparent corner of modern finance. The pitch sounds harmless enough. They say it's about giving everyday Americans access to the same investment opportunities wealthy institutions have enjoyed for years. But what they aren't saying is that the private credit market may be entering a dangerous phase, and the smartest money on the planet appears to be positioning itself for the exit. After the 2008 financial crisis, regulators tightened restrictions on traditional banks. The goal was to reduce systemic risk, but risk in finance rarely disappears. It simply moves. Instead of sitting on bank balance sheets, much of that risk migrated into what's now known as the shadow banking system. Private lenders, private equity funds, private credit vehicles. These firms stepped in to provide loans that traditional banks could no longer issue, and business exploded. Today, private credit has ballooned into a multi-trillion-dollar industry dominated by giants like Blackstone, Apollo, and other massive asset managers. Unlike traditional banking institutions, many of these lending vehicles operate with limited disclosure requirements and far less regulatory scrutiny. That means investors often have very little visibility into the true risk sitting underneath these loans. For years, the system hummed along because there was always fresh capital flowing in, but that flow is starting to slow. In the financial world, institutional investors tend to move first. They see problems earlier, they get access to better data, and when they start pulling money out of a sector, it usually means something is shifting beneath the surface. Recently, redemption requests from private credit funds have begun rising sharply. Some funds have responded by limiting withdrawals or delaying investor access to their capital. That's one of the hidden dangers of private markets. Unlike publicly traded stocks or bonds, many private investments are not liquid. In times of stress, investors may not be able to exit when they want, and when liquidity disappears, the next question becomes unavoidable. Who becomes the new buyer? Wall Street sees retirement accounts as the perfect solution. The U.S. retirement market holds more than $14 trillion in assets across 401ks and IRAs. Even a small allocation shift, say 5% of retirement portfolios, could funnel hundreds of billions of dollars into private credit markets. For asset managers, that represents a massive new source of capital. For everyday investors, it could mean unknowingly absorbing risks that institutions are already trying to shed. There's an old saying in finance, when retail investors arrive, institutions have already left. It's not always true, but history shows it happens more often than people realize. One of the biggest risks with private credit isn't just potential losses, it's access. Many private investment vehicles can legally restrict withdrawals during periods of market stress. Some funds can halt redemptions entirely, others can delay access for months or even years. Now, imagine that happening inside a retirement account. You reach retirement age, you expect to withdraw your savings, but the underlying investments are tied up in private funds that won't release the money. Suddenly the rules change. The money might technically belong to you, but access to it is controlled by someone else. That's a reality very few retirement savers are prepared for. While Wall Street restructures where retirement money flows, another major financial shift is happening at the same time: the rise of stablecoins. Stablecoins are digital tokens pegged to traditional currencies like the US dollar. They're being promoted as faster, more efficient payment systems that could power the next generation of global finance. Major financial institutions, payment companies, and even governments are exploring stablecoin frameworks. On the surface, they look like simple digital dollars, but stablecoins also create the technical framework for something deeper: programmable money. Money that can be tracked, monitored, restricted, or controlled through digital infrastructure. Combine that with expanding financial surveillance and centralized transaction monitoring, and the potential implications become clear. The financial system could move toward a world where every transaction leaves a permanent digital footprint. Programmable currency changes the fundamental nature of money itself. Instead of simple exchange, digital currencies could theoretically be designed to include rules: money that expires, money that can only be spent on certain categories, money that can be frozen instantly. Supporters say these systems increase efficiency and security. Critics warn they could open the door to unprecedented levels of government financial surveillance and economic control. In a fully digital financial system, access to money could become conditional, and that raises serious questions about the future of financial autonomy and sovereignty. When you step back, several powerful trends are converging at once. Wall Street is searching for new capital to support a strained private credit market. Retirement accounts represent the largest pool of untapped money available. At the same time, the financial system is rapidly evolving toward digital infrastructure powered by stablecoins and programmable currency frameworks. Individually, each of these changes might seem manageable. Together, they represent a profound transformation of how money moves, how investments are structured, and how financial control is exercised. And the average American saver is rarely told how these pieces connect. Your 401k or IRA may represent decades of work and sacrifice, but the financial system those accounts operate inside is changing faster than most people realize. Private credit risk is growing, liquidity concerns are rising, stablecoins are reshaping digital payments, and the architecture for programmable money and financial surveillance is quietly being built. History shows that when major financial transitions occur, the people who understand the shift early are the ones who have the best chance of protecting themselves. Everyone else learns about it after the rules have already changed. If you're starting to see the warning signs around stablecoins, programmable digital currency, CBDC risks, central bank monetary control, government financial surveillance, cashless society dangers, and the erosion of financial freedom, then there's one resource you should get your hands on immediately: the Digital Dollar Reset Guide by Bill Brocious. This guide breaks down what the coming digital dollar reset could look like, how stablecoins and CBDCs may reshape the global financial system, and why governments are accelerating digital currency infrastructure. It also explains what individuals can do now to protect their financial autonomy. This isn't optional reading. It's essential intelligence for anyone who refuses to be caught unprepared as the next phase of the monetary system unfolds. Click my bio link and download the Digital Dollar Reset Guide now. Because when the financial system resets, the only people caught off guard will be the ones who didn't see it coming.